8 years ago in the belief that the environment would become a key investment issue. Unfortunately, I was rather ahead of the market, I think, and ahead of the time, and as one of my colleagues puts it, we spent the first 5 years of our existence untroubled by customers. However, we now have a business, and I believe that we've gained a reputation for providing high-quality, investment-relevant research on the environmental impacts of companies. Specifically, we've developed a method for measuring the carbon intensity of different investment strategies and portfolios. And to date, we've performed this analysis on over 800 funds worldwide, worth several $100 billion in terms of their assets. I suppose it's this reputation and perhaps some of the work we undertook for Vic Super last year into the carbon impacts of ASX 200 companies that led the AIST to commission us to look at the carbon risks associated with domestic equity investments in 14 Australian superannuation funds. It's the results of this work published today that I'd like to present to you now. But before I start talking about the results, perhaps it's worth dwelling on why this information is of importance and how it could influence the investment strategies of the future. In short, why is the carbon intensity of a portfolio of investments of any interest to pension funds and their fund managers? Perhaps it's also worthwhile telling you where Trucost comes from in all this. You know, we are not a bunch of eco-warriors. We're not tree huggers. As Andrew said, I'm an investment banker, and they don't come much more cynical than that. But we do believe that climate change is one of the greatest economic challenges that the world has ever faced. In our view, it's an economic issue, it's not an ethical issue. Sir Nicholas Stern's economic analysis of climate change, commissioned by the UK government, concluded that the cost of abating the carbon emissions which contribute to climate change is perhaps 1% of global GDP. Critically, he estimated that the cost of inaction would be between 5 and 20% of world GDP. It's worthwhile also here to say that it is affordable. Mitigating the effects of climate change will cost a lot less than the US subprime crisis in terms of GDP forgone. We can afford to do something about this issue. We can't afford to do nothing about it. Governments around the world now accept the generality of this view. The Kyoto Protocol and its successor treaties will provide an international framework against which emissions reductions can take place. The favoured mechanism that governments around the world are choosing to use in order to reduce emissions and meet the Kyoto targets are laws and regulations which seek to place a price on carbon emissions. In Europe, we have the EU ETS, the EU Emissions Trading Scheme, which, despite early teething problems, has now established an effective and realistic price for 46% of European carbon emissions. That price, incidentally, is around $40 Australian per tonne. Several US states are considering similar action. Last week, Korea announced an emissions trading scheme of its own. Japan already has a voluntary scheme, and it only seems a matter of time before that scheme becomes mandatory too. Here in Australia, the Carbon Pollution Reduction Scheme will create a price of carbon from 2010 and make carbon emissions an economic and commercial reality for Australian companies and the investors in them. When a price for carbon is established in Australia, there will be winners and losers. And the winners will be those companies which are more carbon or energy efficient. If there are to be winners and losers in a financial sense, then investors need information as to who the winners and losers might be. Whether or not they accept the science of climate change, which in my view is irrefutable, the fact is that the laws and regulations which are already coming onto your statute books will have financial effects. Superannuation funds and their investment portfolios that are better positioned with respect to this new financial cost will outperform. And indeed, this outperformance will occur even if climate change is, as the UK's former Chancellor Nigel Lawson would have it, the greatest hoax the world has ever seen. The moment you slap a cost on carbon, then the aggregate carbon intensity of investment portfolios becomes financially material. Well, we wanted to find out whether investing in Australian equities was more or less risky than investing in other markets overseas. We wanted to find out whether all superannuation funds faced the same risks. We wanted to find out whether different investment strategies produced widely different carbon risk profiles. These are the questions that this report seeks to answer, and although some of the figures I'm going to show you now may seem a little dry, it is in this context that they should be viewed. The thing is, we're not trying to say, oh, what a big risk. We're trying to say there are some sensible things you can do in response to a necessary change in the economic rules. These sensible things may well lead to financial outperformance, and certainly, as I intend to show you, all the work that Trucost has done over the last 8 years says that it is absolutely doesn't cost anything in terms of investment performance to position yourself well with respect to the climate change problem. Moreover, where carbon markets are becoming more established, there's the first tentative evidence that factoring in carbon risk has become a winning strategy. Trucost looked at 14 of Australia's largest superannuation funds. Some 100 listed equity portfolios were analysed, 97 long only and 3 long short. This amounted to 31.6 billion Australian dollars of assets, 23% of the total value of the funds, representing most, but not quite all, of these funds' asset allocations to listed Australian equities. An important point to mention here is that, unlike in the UK, there is no legal requirement for Australian superannuation funds to publicly report portfolio holdings. Trucost and the AIST are therefore very grateful that the individual funds decided to cooperate so wholeheartedly with this exercise and provide us with the data we needed. Obviously, holdings data reveals a lot about particular investment strategies. And it's because of this that we've preserved the anonymity of the funds by labelling them through A through to N. Trucost can turn this analysis into individually tailored confidential benchmark reports for the super funds and their trustees on request. The reports will show which asset allocation and stock selection decisions have contributed the most to the overall carbon intensity of the fund as a whole and at a portfolio level. The analysis can also be extended to include international equities held by the super funds. We've done this type of work for the UK Environment Agency's pension fund, for FRR, which is the French state pension fund, and last year here in Australia for VIC Super. So how do we measure the carbon footprint of a portfolio of equities? The first thing we need is a database of the greenhouse gas emissions of each company within the portfolio. The different greenhouse gases are expressed in terms of their carbon dioxide equivalent. So methane, which has 23 times the global warming potential of carbon, is expressed as 23 CO2 equivalents. These emissions numbers need to be standardised and normalised in order to be comparable. Trucost normalises the greenhouse gas emissions of companies to the revenues they generate. Put another way, this measure indicates the extent to which a company emits carbon in order to generate income. This method is also consistent with the Australian climate policy framework. These emissions are then allocated to funds and portfolios on the basis of ownership. If a fund owns 1% of a company's equity, it can also be said to own 1% of that company's emissions. The super funds in this study, in fact, own 2% of the market capitalisation of the companies analysed. These emissions are then totalled up for each portfolio. The carbon footprint is then expressed as tonnes of CO2 equivalents emitted by the companies within each portfolio per $1 million invested in it. We do this so that we can compare large funds and small funds. Otherwise, a fund that was twice the size of another would definitionally have double the carbon footprint. Although the portfolios had a variety of benchmarks, we compared them all to the ASX 200. And for further comparison, we compared the ASX 200 to MSCI Asia ex-Japan, MSCI All World, and MSCI Europe, those indices. So what are the key findings? Well, in aggregate, the funds are slightly more carbon efficient than the ASX 200, with 357 tonnes of CO2 equivalents emitted per $1 million invested. This compares to 370 tonnes for the index. 9 funds were more carbon efficient than the index and therefore less exposed to carbon costs, and 5 were less carbon efficient than the index. There is a 36% difference between the smallest and the largest carbon footprint at the fund level, although, as we shall see, the difference at a portfolio level is substantially greater. I don't know whether you'll be able to read this slide, but what it shows is that the most efficient fund, Fund C, which consists of 3 portfolios, has a carbon footprint of 275 tonnes of CO2e per million invested. In other words, for every £1 million invested in this fund, Australian dollars, in this fund, 275 tonnes of carbon equivalent is emitted by the companies it holds. The most carbon-intensive fund, Fund D, has a carbon footprint of 430 tonnes of CO2e, and as I say, the index is at 370 tonnes. The carbon cost attributable to the funds analysed amounts to some 118 million Australian dollars per annum, using a reference price of Australian dollars 20 per tonne. We've used this because it's the figure most often used for illustrative purposes in the Carbon Pollution Reduction Scheme Green Paper. But this figure is rather low. Carbon prices in Europe are significantly higher than this. Clearly, the more carbon-intensive funds are more exposed to these costs. For the companies, the carbon costs at $20 a tonne average about 0.7% of revenues. So that we can see at the current European price, which is roughly $40 a tonne, that's consistent with Garneau's estimate that the cost of controlling emissions is between 1 and 1.5% of GNP. So what we're faced with here is not some kind of financial Armageddon, but the costs are significant and they're not evenly distributed. Some funds are significantly more exposed than others. It's also worthwhile remembering that carbon costs are a very good proxy for other costs, costs which have risen sharply in recent months and years. The more carbon efficient companies use less fossil fuel. They consume less energy than their less efficient counterparts. They are, as a result, much less exposed to rising oil prices, natural gas prices, and electricity prices. In the last 2 years alone, the returns to eco-efficiency for a company have trebled just by dint of the rise in oil prices. Forget about carbon costs, just the rise in fossil fuel prices is already making a very good case for eco-efficiency. Now I'm going to turn to the carbon footprints of the individual portfolios that make up the funds. As you might be able to see in this slide, there's a much larger variation than at the fund level, but the largest number of funds are grouped around the average. The portfolios in the large bar have carbon footprints between 350 and 400 tonnes. It's interesting that the funds within this mode break down into a number of different investment styles. 8 are value funds, 8 are core, 7 are enhanced indexed, 5 are index, 3 are growth, and 3 are small to mid-cap. The variation between the best and the worst portfolio is close to 8-fold. Portfolios with the lowest carbon footprints tend to exclude carbon-intensive sectors. All of the top 5 best-performing portfolios excluded utilities and construction and materials sectors completely. The most efficient portfolio has a carbon footprint of 76 tonnes, but has no investments in the oil and gas and utilities sectors. The most intensive portfolio has made very carbon-intensive stock selections in the basic materials, chemicals, construction, oil and gas, and travel and leisure sectors. It's important to realise that the sector allocation effects for this portfolio were far outweighed by the stock selection effects. This portfolio could have maintained exposure to these sectors relative to the index and achieved a lower carbon intensity if it had chosen different stocks within the sector. And this is a point I'm going to return to later on. Of note also was that the bottom 5 portfolios in the ranking employed a value investment style. In this slide, we've contrasted the best and worst portfolios with the indices. The ASX 200 is more than 20% more carbon intensive than either MSCI Europe and MSCI World. And these indices are representative of the largest companies in Europe and the world respectively. This is hardly surprising given Australia's reliance on coal-fired power generation, together with the importance of carbon-intensive basic materials and agriculture sectors. In contrast, however, MSCI Asia ex-Japan, which is an index of companies in the emerging Asian markets, has a carbon footprint which is nearly 50% higher than Australia's. The Chinese economy is so carbon inefficient that any global agreement which allocates carbon emissions permits on a per capita basis, as is suggested by Garnaut, would not benefit China much despite its enormous population. We were also asked to contrast the carbon footprints of portfolios according to investment style. Portfolios were characterised as growth, value, sustainability, index, enhanced index, core and small mid-caps. Perhaps unsurprisingly, the sustainability portfolios had the lowest aggregated footprint of 282 tonnes of CO2e per $1 million invested. This was followed by growth, core, mid to small caps and value portfolios, all of which had carbon footprints that were lower than the ASX 200. Again, it's unsurprising but rather gratifying from a researcher's perspective that the index portfolios have carbon footprints which are almost identical to the ASX 200. And only the enhanced index funds had a footprint that was significantly larger than this benchmark. Taking a closer look at the best performing investment styles was also quite revealing. The two sustainability portfolios fared very differently from a carbon perspective. The best was ranked 14th out of the 100, and the other was ranked 75th. This is something we've found quite frequently when we've analysed SRI portfolios elsewhere in the world. It's because there's no single definition of what sustainability means in investment terms, and different fund managers have different interpretations of how to apply it within their portfolios. A catch-all approach could include criteria on the environment, governance, ethics, labour standards, social equity, reflecting the wider evolution of the sustainability agenda. And quite clearly, some of these things will be in conflict with a straightforward environmental perspective. Almost all sustainability funds apply a negative screening approach, where companies and often whole sectors are excluded from the possible investment universe. This reduces diversification and increases the risk of returns deviating significantly from the broad benchmarks. This means that only a limited amount of assets in superannuation funds can therefore be allocated to this type of portfolio. And in my view, these investment strategies are also somewhat economically unrealistic. To exclude the oil and gas sector completely from the investment process is to pretend that the global economy is not substantially dependent on it, and that's clearly not the case. Surely a better approach would be to invest in the more efficient oil and gas companies and invest less in the less efficient oil and gas companies. The growth portfolios, which had the second smallest carbon footprint of the investment styles, some 20% better than the ASX 200. This is because many growth stocks come from the service-based and light manufacturing industries, and because in general these portfolios have selected more carbon-efficient companies within the basic materials sector. I'm not going to spend a great deal of time looking at the other investment styles, as the differences are somewhat marginal, and it would be easy to over-interpret the results. However, I think it's interesting that the small mid-cap portfolios had a footprint that was very close to the ASX 200, despite having no exposure to the carbon-intensive utilities sector. This is because, in general, they had overweight positions in the chemical sector, which made up for it. Both the best and the worst performing portfolios have a value investment style, and they were in aggregate 17% more carbon intensive than the growth portfolios. For me, the interesting fact here is that 8 out of the 10 companies that contributed most to the footprints were common to both the growth and value portfolios. It's just that the value portfolios had much larger weightings in them. The index funds were obviously tightly clustered around the benchmarks. However, it's interesting that the enhanced index funds performed badly from a carbon perspective. This stemmed not from sector allocation decisions, but chiefly from stock selection decisions within the basic materials, construction, oil and gas, and utilities sectors. So what we've established in this report is that different portfolios contain widely different amounts of carbon risk. What can fund managers and trustees do with this information? Superannuation funds can be termed universal investors, and we can see that the vast majority of the portfolios have been invested quite passively with respect to the benchmark indices. So in this sense, the funds lose an important point of leverage with the companies in which they invest. Without the ultimate threat of disinvestment, it can be difficult for large investors to influence company behaviour. One approach that is common now in the US and Europe is for pension funds to engage with companies. They might seek to persuade companies that they should at least disclose their emissions, for example, or indeed work on helping them reduce emissions. And we've worked with a number of very large pension funds across the world to do that: CalPERS, CalSTRS, PGGM, FRR, etc. Of course, the second approach would be to shift assets away from companies with larger emissions, or to switch assets within the fund to less carbon-intensive portfolios. However, this second approach will tend to introduce non-market risks and can result in investment returns that deviate significantly from the benchmark. There is a third approach which I would like to cover in some detail. It's something we've termed carbon optimization. And a number of investment products are now available in the European markets that employ such optimization strategies. In particular, we've worked with UBS to create a carbon-optimized version of the Euro Stoxx 600, which you can buy as a structured product. It allows predominantly passive investors to send a clear message to the companies in which they invest with respect to the environment, without introducing non-index returns. With this type of strategy, sector allocations with respect to the underlying benchmark are maintained. So if the ASX 200 has a 25% weighting in the basic resources sector, a carbon-optimised version of the ASX 200 will also have a 25% weighting in the basic resources sector. The difference is that within those sector allocations, companies will be overweighted and underweighted depending on how carbon intensive they are relative to the average for that sector. In other words, a basic resources company which is 20% more efficient than the average basic resources company will be overweighted by 20% in a carbon-optimised portfolio. And of course, the reverse is also true. To construct the carbon-optimised version of the Euro Stoxx 600 and FTSE all-share indices that we've done already, we were able to backtest using time series data going back 5 and 8 years respectively. Given that carbon disclosure levels amongst Australian companies are quite low, and that Trucost has only been estimating emissions here for the last 2 years, we were not able to conduct such a long backtest of our carbon-optimised version of the ASX 200. However, when we ran the strategy over the last 18 months, we found that we could reduce the carbon footprint of the ASX 200 by 42% without altering any sector allocations. Clearly, a carbon-optimised version of the ASX 200 with no sector biases and with the same constituents as the underlying index might be expected to perform similarly to it. And this indeed was the case. Over 18 months, the difference in financial performance was a mere 0.24%. The annualised tracking error was 2%. In other markets, where we have better data, we've managed to reduce that annual tracking error to around 0.5%. In other words, we can deliver the investment returns of the ASX 200 with much lower emissions. And clearly, as carbon costs increase, as we expect after their introduction in 2010, we would anticipate a portfolio that has been constructed in this way to start to outperform. And here you can see, if people can differentiate between the two lines, that is the performance of the carbon-optimised ASX 200 and the ASX 200. So I'd like to thank the AIST for inviting me to talk to you today and for commissioning this cutting-edge research. I hope it's given you something to think about. Carbon costs are a reality for the Australian economy and will present an investment opportunity, even within conventional investment strategies. And I hope you can take advantage of the opportunities that arise. Thank you very much.